The HUD 223F loan program provides permanent financing for apartment developments all over the country. You can utilize this financing to refinance or acquire assets. The assets should be at least 85% occupied in order to qualify. In terms of seasoning, for let's say you have a building that was recently constructed or rehabilitated, you can utilize this type of financing to refinance that asset, even pull cash out like an equity takeout of that asset. Again, as long as you're at least typically 85-90% occupied. If you're below that threshold, it's going to be a non-starter unless there's some sort of legitimate story as to why you've maintained lower occupancy for some time and how that's going to be changing in the future. This video is going to be less of a overview, frequently asked questions, programmatic type of video, more dollars and cents, underwriting metrics that we use on the lending side to analyze a deal and determine if it's going to be economically viable for ownership to pursue this type of financing. Fundamentally, even if we only have a very limited amount of historical data, like let's say it's a building that's coming out of construction lease up, we want to compare the actual historical financials with the projections that are on hand, and then kind of extrapolate through that data what type of loan amount can be supported relative to the indebtedness or purchase price of a transaction. In this scenario, for the sake of simplicity and brevity, I just have 1 year of historical financials. So in this asset, this is a 33 unit asset. In 2023, this is what they collected in terms of revenue. These were their expenses, not much of the bottom line, but we add back interest and depreciation, showing an NOI of approximately $400,000. On our column here, the lender analysis, we would look at historical figures. We would also look at what are your actual rent roll collections as of the most recent month to give you credit for the rents that you have in place right now. In this scenario, the in-place rents with the rent roll are a little bit higher on an annual average than the previous year, which is good. With HUD, we have to underwrite with certain vacancy factors. So for a market rate transaction, it's 7%. On an affordable transaction, that can go down to 3%. You can have commercial income, but it shouldn't be more than 10 to 15% of the overall project or the underwritten revenue. So less is more when it comes to commercial. HUD doesn't want to be in a position where you have a mixed-use development, 50% commercial. You anticipate a huge amount of commercial space coming in and leasing up. It doesn't happen, and the loan is underwater essentially from day one. So 10 to 15% is sort of your limiter on the amount of commercial space and income that can be in a project. Maybe a little bit beyond that in certain scenarios. When we apply that vacancy factor to the revenue, including the other income, which could be pet fees, RUBS, utility income, late fees, laundry, that type of thing, with the expenses, which we're using 2023 expenses for now, that would also be compared with client projections and ultimately an appraiser's conclusions at time of underwriting. Plus, we add in replacement reserves, which are required as part of HUD, which is typically $250 to $500 per unit per year, which will be determined as part of a property condition report analysis down the road. That works into an NOI that's pretty similar to where we were at in 2023. Generally, the underwriting figures are always slightly lower than historical, unless you have a big bump up in current rent roll rents, because we have to impute that vacancy factor and we have to add replacement reserves on top of that. So we have an NOI of 372. How does that tie into loan amounts? On this page here, this shows the basic kind of framework or three criteria that we use to determine the loan amount under a 223F scenario. The top box here is based upon income or debt service coverage. The second box is based upon costs, and the third box is based upon loan to value. On a cash out refinance, if you're doing a cash out, we don't factor in cost. It's not considered a factor, but you would in an acquisition scenario. So in an acquisition scenario, rather than this being grayed out, you would be including the purchase price plus transaction costs, finance fees, repair costs, that type of thing, times 85 to 90%. So HUD 223F is 85 to 90% of costs, 85% for market rate, 90% for affordable. Similarly, debt coverage 1.176 for market rate, down to 1.11 for affordable. And on the loan to value, it's 85 to 90% market rate or affordable, which decreases to 80% in a cash out scenario if you're pulling equity out of a project like a home equity loan. In this scenario, I'm assuming a cash out refinance of this asset. So the NOI that we showed previously at a 1.176 debt coverage ratio, because it's a market rate transaction, at a 35-year loan term, at a conservative 5.99 interest rate, kind of backs into a loan amount that can be supported of $4.2 million. I can send you the math behind that if you're really interested. This is kind of a peek behind the curtain. So essentially we have the interest rate, we have the mortgage insurance premium, which is a percentage of the rate that flows to HUD that goes up and down depending upon if the asset is energy efficient or affordable or whatnot. That NOI at the rate at a certain MIP over a 35-year term with a 1.176 debt coverage ratio in this scenario backs into that amount of 4.2 million, which again is reflected here on this page. So in this scenario, we're limited by what the income can support. Theoretically, if the rate was going to drop, that number could go higher. If rents were higher, that number could go higher. Expenses were lower, that number could go higher. We're just trying to extrapolate something that's conservative and realistic based upon the actual performance of the asset. In this scenario, we have a payoff of $1.876 million. We have transaction costs, I've estimated costs of repair costs, legal costs, third-party costs. Those are actually broken down here on a more formal source and use of funds. Your third-party report costs, you're probably looking at, I'd say, $25,000 to $35,000. That could go up if you have an older asset that needs like lead and asbestos testing or something like that. But figure 30, 35K is kind of a rough ballpark in terms of third-party costs. There are HUD specific fees plus our lender fee. I'd say generally all in, including our fee, your HUD your fees are going to be approximately 2.5%, maybe 2 to 3%, somewhere is just kind of a ballpark. Plus you're going to have legal expense and you're going to have third-party report costs. So that's where HUD is not as economical for small loan sizes, because you have some basic fixed soft costs in terms of appraisal costs, environmental report costs, that type of thing, where at 10 units, it's not as economical. At 50 or 100 or 200 units, you start to get some of those economies at scale. So in this cash out refinance scenario, again, 33 units, the loan amount, $4.2 million, payoff, $1.8 million. These costs are all mortgageable. So the money that you would spend prior to closing, let's say on an appraisal, you would get credit for that on the settlement statement. It would get essentially rebated to you in this scenario. Our fee is only collected at closing. The MI fee that goes to HUD is collected at closing. The only fee that's due out of pocket other than third parties would be this exam fee, 30 basis points of the loan amount. That is paid to HUD for them to review our final underwriting application before closing. And then that also, because it's mortgageable, is credited towards you on the settlement statement. So in this scenario, loan amount, pay off all the other soft costs built in. I'm showing that the total amount of cash out that would flow back to ownership would be $2.1 million. You may say, why are there two line items here? Well, if you have non-critical repairs, so some sort of repair that can be done within a year post-closing, HUD withholds half the cash out amount until you get those repairs completed. In this scenario, $25,000, realistically, you're probably just going to do those repairs because it's coming from the loan anyway as soon as possible, because you don't want to have that holdback. But I want to be realistic and representative of what a transaction could look like, where, again, the total cash out is going to be withheld by 50% until you complete repairs that are identified as part of a property condition report. The repairs that are identified are repairs that you have a year to do post-closing. You can elect to do that as faster if need be. So you can see in this scenario, HUD can be very powerful because you're getting interest rates that are generally below market. You're getting a 35-year fixed rate loan term, low debt coverage ratio. The loan is non-recourse, so no personal guarantees for ownership. Just because it's HUD financing, you may think of HUD, you may think of affordable housing. There's no affordability set-asides required, no income restrictions that are required. You can lock in non-recourse fixed rate debt, long amortization to maximize cash flow, and pull $2 million out of the project. It's just a very, very powerful form of financing. And the 223F program is much more vanilla than some of the other more in-depth HUD construction type programs. You can do repair work and you can capitalize that and build that into the loan, but it's not like undergoing something where you have to hire a general contractor or an architect. Typically for repairs that are identified as part of a property condition report in this type of financing, it's really going to be repairing a window, replacing a door, that type of thing, something that you can have a handyman do or a local, contractor do, that type of thing. And if you're comparing to a bank, generally it's pretty simple. What would a bank have for a debt coverage ratio? Let's say it's 1.3%, and let's say on a cash out scenario, they're at 70% loan to value. you can see you're losing quite a bit of leverage in proceeds to ownership by going that route. There's no right or wrong answer. There's pros and cons to any scenario, but I think if this is an asset that's more of a long-term hold strategy, if you want to kind of set it and forget it, then the HUD 223F program is hugely powerful, again, for refinances, for acquisitions, cash out refinances. And we're sometimes asked, is it worthwhile to try to secure one of these loans in kind of a rising or fluctuating interest rate environment? And HUD offers streamlined modification options, so you can drop this interest rate in the future, take advantage of the lower rate without having to go through a big, lengthy, formal process where you're getting new appraisals and that type of thing. So it kind of protects investment strategies long and short term. I deal with lots of borrowers, individuals that are maybe new to HUD, don't really know how it works, but they're interested in running through one of these types of scenarios. And I don't need to know any confidential information. We can take your metrics, plug it into a model like this. I can give you a detailed source and use of funds, notes about the transaction, all that type of thing for you to have an option for comparative purposes with other loan programs that are available. And if HUD's a fit, that's fantastic. Or if not, that's fine as well. We just like to educate our clients as much as possible. So I hope this gave a brief breakdown of the 223F program, kind of the metrics that we use to make sure that a program is going to be economically viable. I appreciate you watching, and I'm happy to discuss anytime. Thank you again.